first starting to see cracks, all based on this idea that capex is going to carry this market until it doesn't. What do you think?
I'm not smart enough to be able to pinpoint what inning or even tell you whether it's the earlier or the later innings. What I can tell you, and I think I am qualified to say this, there's going to be a correction, even if we're only in the first inning, as the technologists would tell you. There's just absolutely no way you can have stock prices, hundreds of companies, all revolving around this theme, spread out from industrials to utilities to communications to semis, software. You cannot have of activity and bullishness and Empire State Building-esque vertical charts in perpetuity. It's never happened before, and it won't happen this time. There is absolutely going to be a reckoning. That's not a reason to not invest, because as we've seen over the last 15 years, corrections happen really fast. People don't even get a chance to panic if and when they happen. So I don't think that should keep you out of these stocks or being in the market. I just think people need to calm down. Maybe the right focus is position size rather than some sort of binary in-out decision. And now I'm going to say something that's going to sound ridiculous on its surface, but give it a few hours, think about it later. You'll recognize how profound it actually is. The only thing that will keep this rally, just hear me out and you'll understand.
Go ahead.
The only thing that will keep this rally going is if the rally keeps going. And I know that's a tautology, but the entire premise of the bullishness around this AI theme is emanating from the performance of the stock prices. When did Mark Zuckerberg stop spending money on the metaverse? When his stock price fell by 70% and people were on TV demanding an apology from him. If and when we start to see stock prices stop reacting positively to continued AI capex spending expansion, that's when this will end. Only down stock prices can put an end to the rally. I don't think we're there yet, because every time one of these companies says, hey, remember we said we were going to spend X, turns out it's Y, the stock price goes up 10, 15%. In that environment, why would a CFO and a CEO look at each other and say, let's slow down? They're being rewarded for speeding up.
I hate to inflate a very big head already, okay? But I think he's spot on here. The stock market is what's driving confidence. You're seeing it come in through some of the consumer data. It's all the high-end consumer. And as far as this goes, the minute you see a crack, which is why capex is so important, it's when confidence is going to wane. And I think if you get out of the market now, let's all recognize that if you're early, you're wrong. That's it. The market has punished you for that. And so everybody keeps going on the same path.
So, Amy, BlackRock is said to be near a $40 billion data center deal. There was a Market Watch story that I thought was interesting. It quotes an analyst at a firm called Macro Strategy Partners, says the AI bubble is 17 times the size of the dot-com frenzy and 4 times the size of what we saw in subprime. Michael Hartnett of Bank of America weighing in today as part of the Flow Show note, which we always like to quote. He says, price action, valuation, concentration, and speculation are all frothy and lead to indicators of inflation inflecting higher. But every bubble in history popped by central bank tightening, and no central bank in the world has hiked rates in the past 2 months. Nobody expects any central banks in the world to be tightening policy anytime within the next 2, 4, 6, 8, 10, or 12 months, unless there's a major surprise on inflation that people aren't gathering. How do you want to weigh into this central question in the markets today?
About whether we're in a bubble? Yeah. And look, I think...
Well, you should just continue to buy these stocks, right? Even if we're in a bubble, like we said, it could be the earliest stages. Like, it wasn't so helpful. Yes, I understand, Greenspan's thing that we look back on, but was his statement of irrational exuberance, was it helpful to investors then?
Obviously not. No, obviously not. But I think, but then we were in a bubble and it corrected 70%. So you could have gone out early and still done okay.
4 years earlier.
Not 4 years earlier, but if you started selling in 1999 and missed the last 20% up and then missed the 70% swoosh, you were doing okay. I think the central question around AI is whether it's a natural monopoly. Like, how many people are going to win in this? This will certainly happen. AI will improve productivity, but there are lots of big capex infrastructure things that improve productivity that don't make a lot of money. And so that, to me, is the big central question here. Search is a natural monopoly. You've seen Google at trillion-dollar market caps. Social's a natural monopoly. You've seen Meta. The question is, are we going to have 6 AI players that all compete with each other and therefore drive down prices, like airlines, like Wi-Fi, like lots of other infrastructure projects? In that case, the equipment makers, the NVIDIAs will do fine, but you're not going to end up with the trillion-dollar, ChatGPT might not end up being a trillion-dollar company.
Oh,
I know that's
it's
heresy.
on the way there. You wait till OpenAI goes public,
right.
and then we're going to have these kind of conversations all over again, but on steroids.
Right, and it might start out that way, and then you have to see what the profitability and the return on all this capex eventually is, and we're still a ways away from that.
Yeah, they're the great big bets.
Right.
By the way, as part of that flow show note, Steph, you had the biggest ever weekly tech inflow, $9.3 billion. It's the biggest on record. So just follow the money. Investors obviously aren't worried yet.
I was just going to mention, I talked to a lot of chief technology officers. I'm sure you do
right.
as well. And they're spending on 2 things, double-digit growth from now until the end of the decade. One is AI, because they don't even know what it means for their business. And they're learning it every single day. And the second place that they're spending is cybersecurity. You've heard me say cybersecurity is going to be bigger than AI because AI is not safe. But these are the 2 areas that they are spending double digits. They're going to spend maybe low single digits elsewhere too. But this is something that is absolutely significant.
Well, speaking of cybersecurity, you just bought more CrowdStrike.
Yeah, we did. I agree with you. I think CrowdStrike, if we went to the user conference a couple of weeks ago, AI is not going to have, no enterprise is going to put in AI until they know it's agentic AI until they know it's secure. So
they raised numbers huge at that conference too, right?
Exactly.
20% versus 11% expectations.
Yeah,
amazing.
Well, it's one of the reasons why RBC today says we believe the AI bear case for software and the narrative there is overdone. The point being, you just better be in the right software stocks.
Right.
Right. It's not. You can no longer make a big broad bet on software because
some will be
it's going to have a disruptive thing, either on fundamentals or revenue flows and things like that. You wanted to weigh in on something?
Yeah, I mean, I would say, the record tech inflows, the chase is on into year end. Only 30% of active managers are beating the indices. Positioning net is 55% across aggregate. Yes, CTAs are long, but when you look across the whole body, at 55%, that's not overly